Good morning again, and this morning I'm going to be talking about the R3 standard template for CVAs. I'll be having a quick look at what it is, what it's used for, look at the sort of cases when you might be thinking about using a CVA anyway, and the sort of cases when you might be looking at using the R3 standard template. Then, of course, the question is, how well does it work? And do we think that the CVA standard terms for that R3 have published could be as useful as the IVA standard terms? And then I suppose the question is, do you think you will be using it? At the end of that, I'm hoping there will be a few minutes for questions. So starting off by looking at what it is. It is a company voluntary arrangement. All it is are some template documents to make it easier to set up a CVA in the cases for which those documents are suitable. There are no special rules. There's nothing different about it to make it different from any other CVA. There's no special conditions for using it. Really what it boils down to is that somebody else has done a lot of drafting, so you have to do rather less. But of course, as with standard documents, it's not suitable for all cases. It has been drafted with a particular situation in mind, and what those who compiled it had in mind is an owner-managed business hit by temporary external factors. Now, the genesis of the template really goes back to April, May last year, when businesses were first going into lockdown. The paradigm business that it is designed for has a profitable history behind it, and needs probably only time to get itself back on its feet, at the end of which it should be able to pay its debts in full. So that's the sort of case that it's designed for. And the way it works is it sets up a moratorium, a breathing space for a phased re-establishment of the business. The first phase is an optional one, and it gives the business a short time to reopen itself. Phase one proper is then a breathing space. It's a period of time when the business is trading, is generating revenue, but has a complete moratorium on historic debts. Phase two is the settlement period. So the idea is that by now the business should be re-established, and it is now paying its creditors through the CVA. And phase three is just dealing with the completion of the CVA and closure once the creditors have been paid in full, or at least once the supervisor has enough funds to pay the creditors in full. So broadly speaking, there are two alternative routes into the CVA, depending upon whether the business is actually trading at the moment or whether it needs an introductory period to reopen. And the suggested introductory period is around 3 months to start the business and until it starts trading properly. And then once it has started trading, it then has this breathing space, this moratorium on historic debts, and the suggested period for that is 6 months. And after that, it then moves into the phase where it continues to trade and then pays the supervisor to pay the creditors. The suggested period for that is 12 months. And then at the end of the CVA, there's a further 3 months allowed to wrap it up and close it down. There are some semi-official variations that are freely available and that are worth considering. So in addition to these two possible routes into the CVA, the two alternative opening phases, there are also variations that deal with a situation where perhaps the business needs creditor protection in the form of an administration before the CVA starts. And there's another variation that allows for the CVA to be offered to creditors on the basis of asking creditors to take a write-off of some of what is due to them. So all in all, there are many different flavours of this standard template that are designed to fit quite a wide range of different types of situation. As I've already said, it basically it's a normal CVA that uses standard documents, and the purpose of that really is to save time, to make it a more cost-effective type of CVA. But it does mean that you can only really apply it to cases which actually fit the standard documents. The official suggestion, if you're using the template, is that if you are varying the template at all, then you should put those variations into an appendix rather than making changes to the Word documents themselves. So that way, anybody who's familiar with the template will be able to see what the changes are. I'm not entirely convinced by that idea, because that may make it difficult for people to actually track through the way that it works if they need to have open on their desk the proposal, the standard conditions, and an appendix of changes all at the same time. That can be quite difficult. Let's look at the sort of cases when you might be using it. I mean, the first thing you have to think about, of course, is the case suitable for a CVA at all? Because if it's not, then there's no point in looking any further. So again, back to basics here on CVAs, and my apologies for that. So first of all, of course, is a CVA is a turnaround process, and that's something which immediately makes it different for us as IPs looking at it, because we need to be thinking about how the business is going to operate when it's in the CVA. If it's a liquidation, we're burying the business, we don't need to think about what happens afterwards. If it's an administration and we're selling it as a going concern, then that's really for the buyer to decide how they're going to fund it, how they're going to manage it, what changes they're going to make about the business. If you're going to be the supervisor of a CVA and you are dependent upon the continuing success of that business in the CVA to generate the income with which to pay the creditors, then you do owe an additional responsibility to understand what is changing about the business and how it is going to succeed. And typically in turnaround work, we talk about moving the business to a new place in 3 dimensions. And the dimensions are finance, management, and business. So in terms of the financial arrangements, you'll be looking at the working capital that's available to the company, whether it's enough, whether the creditor indulgence that's being offered through the CVA is going to be enough in the light of whatever new working capital is available to the business for it to be viable. You'd be looking at the management, their ability, their credibility, and what changes might be needed to be made to the management to make the business succeed. Now, if we're looking at something which is, say, a pub or a club which has simply had to close because of government regulations and can now reopen for the first time, then if it was successful before, there may not be too much of an issue about the management. But if in any way the world has changed, the business sector has changed, then we'll be needing to look at what adaptations the management can make and whether some of the people running the business need to be changed. And then you'll be looking at the business plan for the business itself, what its immediate plans are in terms of turning itself around, trading back to normality, what the medium plan is, and what its strategic objectives are. So those are the 3 dimensions that you're looking at. Now, if having looked at all of those, it does look as if the business could work in a CVA, I think you then need to look at the creditors. And the obvious thing to look at, of course, is the need for a 75% majority of unsecured creditors, and also the statutory need for us not to be depending upon connected creditors to be forcing through the CVA against the wishes of a majority of independent creditors. We now have to think about Crown preference as well, and the CVA will have to provide for the Crown as a preferential creditor to be paid in full, which is going to mean less for the other creditors. We also need to think about whether key suppliers will still support, whether they're going to be looking to be duress creditors and looking to be paid faster than other unsecured creditors as a condition of providing their support. And we need also to look at the attitude of secured creditors. Even though they may be fully secured, will they allow the company to remain in possession of its assets, or will they regard the company as having been in default, and they may not be willing to continue to extend their credit to the company? And also, whilst looking at creditors, also need to think about whether the creditor pressure on the company is such that it needs an immediate moratorium, perhaps in the form of an administration to give it protection. Now, with the lifting of the statutory bar on landlords' remedies and winding up petitions coming to an end in a couple of months' time, this is something that we may need to look at with a new enhanced sense of urgency about it. We may need more administrations than previously. So supposing we've got a turnaround that looks like it's going to work in a CVA, and it looks like the creditors will support the proposal, both in terms of voting for it and actually in providing both active and passive support necessary to allow it to be implemented. There are other things we need to think about as well. Things like reputational issues. Will the goodwill be damaged by the CVA? Will competitors take advantage of it? Will the business lose customers? Corporate complexity. Is this a standalone company, or is it linked to others? What will be the knock-on effect of the other companies in the group? And stepping back, before investing too much time in a CVA, would it be easier simply to pre-pack it and sell it back to the existing management? Remembering, of course, the need for either creditor approval or an evaluator then to approve the transaction if we're doing it that way. Or perhaps even think about a light touch administration if there are relatively few creditors. This is one where essentially the administrator will remove the prohibition on the directors exercising their powers, so that there is the administration to provide immediate protection against creditors. And if there's only a small number of creditors, then leave it for the directors to do one-off deals with individual creditors, at the end of which, once they've got the deals in place, perhaps the administration could be exited and the company could continue trading normally. So that's looking at it in terms of how CVAs work and whether this is suitable. The sort of cases that the standard terms were designed for are smaller businesses, owner-managed businesses with a profitable history that need only time to be able to restore themselves to profitability and to generate the cash to pay creditors in full. Now, the history of the templates was that they were written just over a year ago, and perhaps at that point the anticipation was that circumstances may have been rather different. So the template was only launched in October last year, and a lot of businesses have come out of lockdown already. There are still many that are adversely affected. Some have reopened. The reopening may be temporary, and we're now expecting the final restrictions, at least the legal restrictions, to be lifted in 7 days' time, although again that may be only a temporary lifting of restrictions. And the sorts of issues that perhaps were not anticipated when the terms were designed, and which you will perhaps have to think about when thinking about whether a CVA is possible, is whether there is already significant accrued debt to creditors. For example, there may be 6 months, 12 months of unpaid rent that needs to be sorted out. And I think something that we are going to see is disagreements between landlords and tenants about the terms on which the payment of rent has been suspended. written off, merely suspended? Does interest run? What rights do the landlords now have? All sorts of issues like that. And then there's also going to be the likelihood that the business will have taken on additional debt, probably in terms of some of the government-backed schemes, so that there will be more debt in it now than might otherwise be the case. And one of the things to look at there, of course, is what has happened to the government-backed loans that have been borrowed by the company. And we're already starting to see examples of cases where that money has been used to pay remuneration to directors rather than to preserve the business. So looking at the template itself, what have you got in it and how well does it work? There's basically two main documents in it. There is a standard proposal, which is the outline of the basic offer that is put to creditors, and then there are standard conditions as well. Standard conditions being very similar in many ways to the R3 IVA standard conditions. They're basically the legal terms and conditions that will apply to the CVA if approved. So this is the way that the standard proposal is structured. It opens with particulars. I think this is quite useful. It's just a table of the commercial terms that are being offered, and then goes into the body, which explains the timetable for creditors of the CVA, both in terms of its approval and its implementation, and explains the effect of the CVA if it is approved. And then there are 6 standard appendices to the template. The first one is the new CVA standard terms. The second one are any amendments to the standard terms, which should be in a separate appendix. Then there's the statutory information that is required to be included so that you've got it in one place to make sure it's all there. Then there is the financial information, details of assets and liabilities, any guarantees, and an estimated outcome statement. Then there is the story of the business as a separate appendix, and then Appendix 6 is dealing with remuneration and expenses. Now, the way that the standard proposal works, what the text in the body says, is that essentially all of the business's assets are excluded from the proposal. They are not made available to the supervisor, and the only funds that the supervisor has in the CVA are the monthly instalments from the business, and it's from that dividends to creditors will be paid. The standard proposal goes on to say that debts to connected parties are regarded as deferred and will be paid last, and during the term of trading governed by the CVA, shareholders will not be entitled to any dividends, and the directors' remuneration will not increase. Now, I can see difficulties over those two issues simply because so many businesses of this sort don't have any formal arrangements in place for paying shareholders and directors. As you know, it is simply done on the basis of monthly drawings, followed at the end of the year by a discussion with the accountant, who suggests to the directors how the loan should be repaid by declaring directors' fees and dividends. So in many businesses of this sort, there simply is no arrangement in place for a director's salary. And I think that's something that would have to be put into the body of the CVA in most cases, just so that you've got clarity about it. As the supervisor, you're given the right of veto if the business is proposing to enter into any new liabilities that are not in the normal course of trading, and particularly if they're intending to enter into any new borrowing to fund the business. And it will be a breach of the voluntary arrangement if the business does not pay new debts that it incurs when they fall due. So it has to pay its debts as it goes in future trading. The standard proposal envisages that the company will trade normally. There will be no significant changes to the way that it has been trading previously. And it does give you, as the supervisor, a discretion to extend the duration of each of the phases in the CVA. And in particular, you do have the discretion to suspend the payment of instalments into the CVA if the business has to close or reduce its activities again for any length of time. So that's what's in the proposal. As I say, the other main document are the standard conditions, and these are very, very closely modelled on the standard conditions for IVAs. I'm not intending to go through them clause by clause, but there is a markup available which shows the differences between the IVA standard terms and the CVA standard terms, and we'll send you an email with a link to a cloud folder with that in at the end of this presentation. So in terms of the standard terms themselves, how useful are they going to be? I think probably they are a good starting point for small business CVAs, and I actually do quite like the structure of the standard proposal, particularly the opening particulars. So I think even if you've got a CVA case where you're perhaps not able to use the standard template documents exactly as intended, I think they probably are very often going to make a good starting point, rather than having to do white paper drafting of the detail from the outset. When it comes to looking at the more complex CVAs, and I'm thinking here of the retail restructuring ones, yes, I mean you are going to need a specialised form of proposal for that and a specialised form of terms for that. But I think it's probably a good standard basis, and in a way it's a shame that it's taken so many years to have something that's being put forward as an industry-wide standard like this. So will you use the template? Well, I think I probably will, and I suspect you probably will. It does seem to be quite a sensible, quite a conventional model for a CVA, and although it is designed for quite specific, fairly narrow circumstances, it certainly has the ability to be adapted to fit other circumstances. And in many cases, it's going to be easier starting with something like this, which is going to be a known quantity, than having to start from fresh. As I said right at the outset, it is just a CVA. It's not a whole new procedure. It's not anything radically new or different. So it has exactly the same constraints and limits as CVAs have always had. And I suspect the world may have moved on from how we thought it would be back in April and May last year when this template was being devised. And I suspect that the number of cases that we're going to see in the next 3 to 6 months where this template is going to be absolutely spot on may be fairly limited. And I think we will still certainly be looking at the other options, particularly administrations, pre-pack administrations, and liquidations as well. So that, I think, in just about half an hour is all of the points that I wanted to cover this morning. If anyone has any questions, please do type them in the chat box now. Be very pleased to hear from you if you do. But otherwise, I will say thank you all very much for joining me for this. I'm delighted that my internet doesn't seem to have fallen over, and I look forward to seeing you again next month. So thank you all very much and goodbye.